post on his X social media network, Musk said, "I'm sorry, but I just can't stand it anymore. This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it."
He called it a disgusting abomination. Elon Musk, once Trump's closest private ally, is now publicly attacking the president's signature spending bill. From being welcomed into the White House to urging Americans to kill the bill, Musk's reversal is dramatic. What caused the fallout? And is Trump's one big beautiful bill as dangerous as Musk claims? Let's break it down. In early 2025, Musk joined Trump's second-term effort to slash federal waste. He spent $288 million backing Trump and was appointed to lead the Department of Government Efficiency, DOGE. DOGE cut 250,000 federal jobs, reduced funding to agencies like EPA and NOAA, and suspended numerous federal programs. Musk compared the federal government to a giant DMV, saying smaller government was the goal. But the backlash was intense: lawsuits, protests, and threats. Tesla's profits dropped 71%, and Musk's approval outside GOP circles sank. Still, he defended the mission, until Trump's next move changed everything. In May, Trump unveiled the One Big Beautiful Bill, a massive tax and spend plan. It extends the 2017 tax cuts, adds new tax breaks for overtime and Social Security, increases defense and infrastructure spending, and cuts Medicaid and green energy programs. According to the Congressional Budget Office, the bill would add $3.8 trillion to the national debt over 10 years, essentially wiping out DOGE's savings. For Musk, that was the breaking point. By late May, Musk officially stepped down from DOGE, the efficiency agency he once led. His departure came just days after a CBS interview where he criticized Trump's spending bill and admitted DOGE's savings, around $9 billion, were wiped out in a year. Soon after, Musk turned to social media.
Elon Musk put on his website X, quote, "Call your senator, call your congressman. Bankrupting America is not okay. Kill the bill," end quote.
He called the bill massive, outrageous, pork-filled, and urged Americans to kill the bill. He accused Congress of destroying months of reform. He wasn't alone. Senators Rand Paul and Josh Hawley raised alarm over debt and Medicaid cuts. But critics claimed Musk's anger was partly personal. The bill removed EV tax credits, excluded Starlink from FAA contracts, and nixed Musk's pick for NASA chief. Still, Musk insisted, this isn't about Tesla, it's about bankrupting America. Despite the noise, most Republicans support the bill. Why? If they don't act, the 2017 tax cuts expire, triggering a $4.5 trillion tax hike by 2026. Trump's bill aims to prevent that. Senate Majority Leader John Thune argues the plan will generate long-term growth and historic savings. But the math is debated. Musk's plus 63 favorability in the GOP is strong, but still trails Trump's plus 79. And Trump has stayed silent, choosing not to engage Musk directly.
This is not a big, beautiful bill. It's a big, beautiful betrayal of the middle class.
So what is the One Big Beautiful Bill, really? Is it reckless, as Musk claims, or necessary, as Trump argues? The answer is nuanced. On one hand, the bill includes $1.7 trillion in tax cuts and may indeed deliver short-term economic stimulus. Inflation has cooled since early 2024, and consumer spending remains resilient. On the other, the CBO warns, the bill doesn't curb debt, it accelerates it. DOGE's $9 billion in savings? Gone in a month. For fiscal conservatives, it's a bitter pill. For Trump's base, it's a promise kept. But as Musk put it, a bill can be big, or it can be beautiful. But I'm not sure it can be both. The Trump-Musk partnership may be over, but the real story is just beginning. Will this bill supercharge America's economy, or set it on a path toward deeper debt? We'll be tracking the data. If you want clarity without the noise, subscribe to our channel. See you in the next video.
If I didn't do that deal with China, I think China would have broken apart.
The U.S. and China have paused their escalating trade war. Tariffs on Chinese imports were cut to 30% from 145%. still far higher than before the Trump administration regained office.
President Trump just returned from his Middle East tour with billion-dollar deals, a controversial private jet gift, and one big claim: if I didn't do this, China would have broken apart. Yes, Trump says his tariff strategy didn't just protect America, it saved the Chinese economy. But while Trump celebrates the 90-day tariff rollback as a win, the aftershocks are hitting U.S. importers, consumers, and supply chains hard. So let's unpack what's really happening on both sides of the Pacific. In a recent interview, Trump doubled down on his message. Without his tariff strategy, it wouldn't be the U.S. economy at risk, but China's. He credited the 90-day tariff pause, cutting U.S. import taxes on Chinese goods from 145% to 30%, as a strategic masterstroke that kept China from collapsing. The statement echoes commentary from Trump allies like Larry Kudlow, who told Fox News that China is in fragile condition and secretly begged for negotiations weeks before the deal in Geneva. But as Trump paints himself as the economic savior of Beijing, many experts warn this isn't a full agreement, it's just a pause, a tactical ceasefire. And China? It's still playing hardball. State media maintains aggressive rhetoric, and trade expert Gordon Chang notes that China has yet to reduce its non-tariff barriers, long considered the real obstacle for U.S. exporters.
The rate of deflation in China, I mean, every price is falling in double digits. What does that tell you? It tells you their economy is imploding.
So, did Trump's tariff war bring China to the brink? Well, China's April economic data shows a mixed picture. According to Bloomberg, industrial production rose 6.1% year over year, beating expectations. But retail sales missed projections and property investment continued to decline. The yuan is under pressure, inflation remains low, and youth unemployment and social discontent are rising. Even Chinese Gen Z workers have gone viral for calling themselves rat people, opting out of jobs, protesting burnout, and leaving cities to take up farming. And yet, Beijing refuses to bow. Instead, it's diversifying its trade relationships, particularly with Latin America and the Middle East. So did Trump save China, or just buy it more time?
Prior to the pause, bookings were down 30% to 50%. 20% of vessels coming from Asia to the West Coast were cut, 18% to the East Coast. Container ship capacity from China to the U.S. dropped by nearly half in May 2025 from a year earlier. After the 90-day reprieve was announced,
back in the U.S., the short-term economic pain is already unfolding. At the Port of Los Angeles, Executive Director Gene Soroka told Fox Business that cargo volumes in May are down 25%. Out of 80 scheduled ships, 17 have been canceled. Why? Because many U.S. companies slammed the brakes on orders when tariffs hit 145%. Even now, with tariffs cut to 30%, the port isn't celebrating. Soroka warns that 90 days isn't enough. It takes 3 months just for goods to move from China to U.S. store shelves. CNBC reports that during the tariff spike, container capacity from China to the U.S. dropped nearly 50% in May 2025 compared to a year earlier. That's a massive shock to the $1 trillion U.S. freight industry, which is now scrambling to handle a surge in delayed shipments. Meanwhile, everyday Americans are feeling the pinch. Even with the rollback, a 30% tariff is still 3 times higher than pre-Trump levels. And it shows. Walmart just confirmed during its Q1 earnings call in May 2025 that it will raise prices on essential items, everything from electronics to home goods, due to lingering tariff costs. FreightWaves estimates that U.S. trucking volumes dropped 5% nationwide through June due to the import collapse, threatening layoffs across logistics and warehousing. And the consumer price index may be misleading. April's CPI rose just 2.3% year over year, according to the Bureau of Labor Statistics. But economists like Carrie Freestone from RBC Capital warn that inflation data hasn't fully captured the impact of these tariffs. Much of the current inventory was ordered before tariffs spiked. And as that stock runs out, price increases are expected to accelerate into summer. So here we are. Trump says he saved China. But back home, American ports are empty, trucks are idle, and consumers are paying more. Was it a brilliant deal? Or just another short-term patch that leaves businesses and families caught in economic whiplash?
the issue. Concern with what's happening in Washington when it comes to the spending bill, when it comes to adding to the deficit, certainly top of mind.
This is the 30-year yield minus the 10-year yield. And you could see that we are virtually at the highest levels going back to 2021.
Yields are surging, auctions are failing, and America's debt is suddenly back on the radar. Wall Street just saw the 30-year Treasury push past 5%, while a weak 20-year auction sent tremors through the market. What's fueling the spike? A massive tax and spend proposal out of Washington that's reigniting fears of long-term fiscal strain. Today, we unpack how this bold fiscal agenda is colliding with bond market realities, and why it matters for every American household, not just investors. At the center of this turmoil is the Big Beautiful Bill, a sweeping package that combines tax cuts, new federal spending, and sharp policy shifts. On paper, the plan extends Trump-era tax reductions, eliminates income taxes on tips and overtime, and increases outlays for defense, energy, and border security. But it also proposes cutting Medicaid funding and rolling back green energy incentives. Budget analysts are sounding the alarm. The Congressional Budget Office estimates the bill would add between $3.8 and $4 trillion to the federal deficit over 10 years. That would take U.S. debt from around $36 trillion today to $56 trillion by 2034, pushing debt to GDP levels toward 125%. Even some fiscal conservatives are calling it unsustainable. But for markets, the concern isn't just the number, it's the trajectory.
That means that the private sector is going to be forced, especially in the U.S., to absorb a lot more debt.
And that concern is showing up in real-time trading. Last week's 20-year Treasury auction was one of the weakest in recent memory. Demand faltered, prices fell, and yields jumped across the curve. The 30-year Treasury yield climbed above 5%, its highest since October 2023. A move that spooked both institutional and retail investors. CNBC's Rick Santelli called it a wake-up moment, saying this was the first time in years that bond markets were pricing in serious doubt about fiscal sustainability. Another warning sign? The spread between 10 and 30-year bonds, often seen as a barometer of long-term risk, has widened to levels last seen in 2021. That tells us investors are demanding more compensation for holding long-term U.S. debt. But this isn't just a domestic story. Foreign investors, who have long played a critical role in financing U.S. debt, are stepping back. Carl Shimada, chief strategist at Corp, said international fund managers are now redirecting capital toward Europe and Asia, citing eroding confidence in American institutions and economic policy. That's a serious shift. For decades, U.S. Treasuries have been the go-to asset for global stability. But as deficits widen and political divisions deepen, that status is being reassessed. There are also currency implications. As demand for treasuries weakens, so does the appeal of the US dollar. While still strong in the short run, analysts warn that a multi-year trend of diversification could lead to a gradual erosion in the dollar's global dominance, which could raise import prices and further complicate inflation control.
And that means that, not only does U.S. growth potentially slow and potential growth slow, but also that the, private investor in the U.S. is going to be forced to absorb so much more debt.
This isn't just a bond story, it's a household story. When Treasury yields rise, mortgage rates often follow. So do rates on auto loans, student debt, and credit cards. Businesses pay more to borrow. Cities and states face higher costs to fund infrastructure. And the federal government? It ends up paying more just to service the interest on its debt, diverting resources away from public investment. To make matters worse, the Federal Reserve is now in a bind. Higher market yields could stall the Fed's ability to cut rates later this year, even if inflation cools or job growth weakens. The central bank doesn't set long-term rates, but it certainly watches how markets are moving. Right now, those movements are flashing warning signs. So while Washington promises a beautiful boost to growth, the bond market is sending a very different signal. Yields are exploding. Foreign capital is drifting. And for the first time in years, America's fiscal future is front and center in every portfolio manager's dashboard. If this breakdown helped you understand what's unfolding and what it means for your money, Hit subscribe and drop your thoughts below. Thanks for watching and see you in the next video.